Joining us now is Mike Wilson, Chief Investment Officer, Chief U.S. Equity Strategist for Morgan Stanley. We go way back. We've got a lot of history, more than some marriages, Mike. And in the past, I've talked about when I thought you got bearish too soon. And this time I thought you were staying bullish much longer. And I didn't realize that you did, I don't know whether I'd call it bearish, but you pulled in your horns to some extent, because 3,900, it's gone way out of, it's gotten away from you at this time. When did you go to 3,900? At the beginning of the year?
Yeah, Joe, I mean, we've been at 3,900 since, we put our forecast out for this year. And I mean, it's still a year-end target, and things do overshoot. And maybe we underestimated how far it could overshoot in the short term. And look, the other thing we do, as you know, Joe, is we try to focus people on the right things. And the internal movements of the market have actually played our mid-cycle transition perfectly, right? I mean, the early cycle stocks have underperformed, small caps have underperformed, the market's gotten narrow, the quality trades worked really, really well. So all the things are happening except for the final piece, which is just that the index has to derate lower. And look, the thing that's going to make that happen is when the market finally accepts the fact that the Fed is going to have to start tightening policy. It's not the end of the cycle. People get so negative when the Fed's tightening policy. Let me assure you, if the Fed wasn't tightening policy, that means the recovery failed. This is a normal progression. So look, we're very disciplined. We have a process. We don't get caught up in price action. The risk reward at this point at the index level looks not that great. As you said, I mean, it's 4,000 is 10% downside, not the end of the bull market. By the way, every year we get a 10 to 15% correction generally. So that should be what you expect. And it's just, I don't think it's that unusual.
Right. I felt it too. I know the inclination that you're feeling, and no one can really, ignore the Fed's influence on this. It just seems like day in and day out that there's some support, and there's just this, the default move is up almost just about every day, and it's been that way. And I know you've seen it. When I said we've had history, I remember last time I used to needle you about being too bearish, and you were bearish for some very good reasons, but you were able to turn bullish for a reason that wasn't what you were talking about. You were able to get in, and it kind of bailed you out. I think the pandemic sell-off to some extent allowed you to get long and stay long much longer than many of your peers. So I wouldn't say I was disappointed that then you went back. I have deja vu for you being out of the party too early again and looking for a way to get back bullish again when the opportunity arises.
Well, I mean, look, that would assume that I was trying to game the system. I mean, look, once again, Joe, we have a process around risk reward. Okay.
Right.
So I think it's fair to say that, the risk reward today on equities broadly is not nearly as attractive as it was a year ago when people were panicked. So that's our job, right? Our job is to keep clients out of harm's way and to take good swings when the pitch is fat. And that's what we're doing again. It's that simple.
The reasons to think that there's some fluff here, they hit us over the head almost every day. And we always just come back to the notion that there's just so much liquidity. I don't know, in hindsight, when the party does at least end a little bit, or where the NFTs don't go for $8 million, whatever you want to point at that seems to represent the fluff, when we look back on it, maybe it's going to look obvious that this had a lot to do with the Fed staying so long and providing so much liquidity, and central bankers around the world.
Yeah, but it's not just that, Joe. It's also the fiscal policy, which has been extraordinary, right? That's what's been different this time, and they're working hand in glove. And that was, part of the reason it got us very bullish over a year ago, and it's played out, though, right? So, one of the things that I don't think does get enough airtime, I mean, liquidity and trying to time, when the market will care about that, it's always a challenge, to say the least. The internals of the market have played out, I think, in a much more forthright way that would assume that liquidity is starting to fade a bit. Okay, but let's talk about the fundamental picture too here. We are seeing a deterioration in the fiscal impulse. Okay, I mean, these packages are wearing off, just like the monetary policy is going to have to go the other way. And I mean, like, look at today's results with Home Depot. I think it's a really good example where, they missed the numbers slightly, but more importantly, inventories built much more quickly than the end sales. And this is, I think, what we're going to assume. One of the things we need to pay attention to in the next 6 months is there's going to be a payback in demand for a lot of these things that were overconsumed over the next year. That's the other part of our story. We're not as bullish on earnings over the next 12 months because of that potential payback. And then, of course, The other thing is you got to pay for some of this stuff, which means higher taxes. So it's not the end of the world. It's a normal market type of progression through an economic recovery. Our job is to find places to make money in that environment, and we've skewed up the quality curve, and it's been working quite well.
Shepard Smith here. Thanks for watching CNBC on YouTube.